Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
February 17, 2026, holiday shortened week with President's Day taking center stage here. Let's take a look at the big picture. Brent crude's up 13% for the year, so we have a winner in commodities. Silver up 8.5%, winner in commodities. Gold up 16.2%, winner in commodities. Bitcoin down 23% for the year to date. Morgan Stanley Country Index All World up 2.42%. That doesn't sound like a lot, but when compared to the Magnificent Seven, which is down 6.3%, an all world stock portfolio is beating the best of the best, so to speak, in the United States. Russell 2000's up 5.5% year to date. Small companies in the United States having a great year. The Nasdaq's down almost 3% year to date. If trends continue for the rest of the day, that will be down 3% for the year. S&P 500 down 1/3%, and the Dow Jones Industrial Average up 2.3%. So the S&P 500 heavily market weighted with the Magnificent Seven, underperforming the Dow Jones Industrial Average, which has a more diversified base. I don't want to say it's fun to watch, but there is some value in getting up every day and doing research. Hopefully you're not freaked out by greed or fear, because this market seems to give you healthy doses of both of them. So for the day, the S&P 500 is down 16, the Dow Jones Industrial Average is up 42, the Nasdaq down 101, the Russell 2000 down 6. There's a vibe that is a very thinly traded market. If you pay attention to CNBC or Bloomberg, the interviews just don't have a lot of zip today. Gold fell below 4,900 in the holiday thin trade as the dollar rises. So right now, gold is down 166, down 3.29%. That's a pretty dramatic move. It's in at 48.80. Silver is down $5.31, down 6.8%. Copper's down 15 cents, but that's down 2.7%. So commodities are taking a breather or a day off or a holiday shortened week where they're just not actively traded. 10-year Treasury sits at 4.05%, getting close to that 4% level. That turns into a tipping point for being more bullish on stocks. And yet the stock market isn't correcting to the point of saying, oh man, everything's falling apart. Now is a buying opportunity. There's a dip going on, but it isn't an aggressive dip yet. Big bank CEO pay surged by $45 million in 2025. The bosses across Wall Street's 6 biggest banks all saw their pay jump after a banner 2025. CEOs for JP Morgan Chase, ticker symbol JPM, Bank of America, ticker symbol BAC, Citigroup C, Wells Fargo WFC, Morgan Stanley MS, and Goldman Sachs all earned $40 million or more in total compensation last year. Collectively, their pay increase for 2025 rose by about $45.3 million from the year before of $258 million. That's a staggering number. I think as I get older, I go, when is enough enough? I have enough in my portfolio that I'm not judging myself on the same levels, but I'm also not taking as much risks as I did when I was in my 20s. I'm in my 50s. Holy mackerel. When did life go by? As the market's struggling today with tech and growth, Apple's doing its thing. It's up. It's a very easy trend to see. It seems to outperform when the market underperforms, and it seems to underperform when the overall market outperforms. Consumer staples are almost flat today, but there's some weak leadership from packaged food names like General Mills, down 7.7%. That's a big down day for a big, boring company like General Mills. And yes, you know General Mills from cereal. What can cause them to get hit today? Health and Human Services Secretary Kennedy said on 60 Minutes that ultra-processed foods are responsible for the country's obesity problems. When you get a high-profile news program with a high-profile politician, it can create a pretty good hit. So Campbell's Soup down 7.7%. General Mills down 7.7%. ConAgra down 5.7%. They reaffirmed their guidance for 2026. Dollar General down 3.88%. Rothschild and Redburn downgraded the stock to sell from neutral with a $111 price target. Walmart's a little bit lower. They hit a fresh record high on Friday. So they're closing a little, they're not closing, but they're moving a little bit lower today. Colgate-Palmolive down 1.29%. I'm getting the vibe that today's not that, I'm not going to say it's not that big of a day, but it feels underwhelming in the sense that I'm not going to make a lot of judgment on the short term of the market based on today. It's just so thinly traded right now. CNBC is reporting that Netflix has granted Warner Brothers Discovery a 7-day waiver to reopen potential deal talks with Paramount Skydance, which trades sharply higher today, up 6.4%. Ticker symbol on Paramount Skydance, PSKY. Warner Brothers Discovery up 3.29%, sitting right at just under $29. Will Paramount Skydance up their price target? Maybe how much they're willing to spend. Interestingly, Netflix is $76 a share. That stock will recover if Paramount Skydance ups their bid for Warner Brothers Discovery and Netflix were to bow out and get a breakup fee. Alphabet down today 1.3%. Communication sector is firmly lower. Southwest Airlines up 6.3%. This was an obvious trade the moment they said that they're going to start charging for bags and start doing charging premium seating to get on the plane first in the bigger seats. It's a no-brainer. It still has 3 more quarters of really nice numbers on top of previous numbers. Now, again, that's saying that there's not going to be a 9/11 or something that really disrupts the travel industry between now and then. A little bit of mega cap weakness today, and AI disruption concerns continue to hold the market in check. Bitcoin remains stuck in a rut, which has dampened some of the market's risk-on behavior. Danaher is acquiring Masimo. Masimo and Apple, you might know, have had a beef for the last few years as Masimo makes a blood oxygen sensor that they say Apple has infringed on the use of the patent. Apple has gone a different route. Instead of telling you what your blood oxygen level is, which was very, very helpful during COVID, to question, am I sick? Am I dying? And you would look at your blood oxygen rating and you go, oh, no, I'm at 94, 95%. I'm fine. I'm getting enough oxygen in my blood. That was one of those things that COVID took away from us, our oxygen in the blood. Elliott Investment Management has built a 10% stake in Norwegian Line Holdings, a cruise. So there's a little mergers and acquisitions. Danaher acquiring Masimo. A little activist investor going on with Elliott taking a stake in Norwegian Cruise Lines. Will she, won't she? Paramount, Skydance, and Warner Brothers, Netflix. Anthropic's ads for the Super Bowl, which made fun of OpenAI, led to an 11% user boost. Now, Jonathan Krinsky from BTIG released a note this weekend, research note. It was titled A Tale of Two Cities. Dispersion continues as indices churn. I like Krinsky. And if you want to pull up his last name, it's Krinsky. Quote, he said, the S&P 500 first traded above 6,800 on October 24 of 2025. It has essentially traded sideways since then, yet 4 sectors are up 12%. Energy, materials, staples, and industrials, while 3 sectors are down almost 3%. Financials, discretionary, and tech. The equal weight S&P 500 is up 6%, small caps up 5.4%, and the all-world ex-US is up 10.2% in that span. For participants, this is not a new revelation, but does continue to highlight how much dispersion there is below the surface on Wall Street. The million-dollar question is, which way does the bifurcation resolve? Now, some of the points that Krinsky made after this opening statement include extreme dispersion often results in a broad weakness. Typically, when parts of the market are exhibiting extreme weakness, like software is, others are showing strength, like cyclicals. It's the strong names that succumb and catch down to the weaker ones. Yet so far, the new leaders have shown little evidence of wanting to correct. His next bullet point to discuss: seasonals are turning bearish. We move from the holiday period and the Santa Claus rally to a more dull part of the calendar that we can expect a broad wobble. It would be now through mid-March. That's when we had last year's correction. The market rarely repeats the same pattern in back-to-back years. I guess that seasonal turning bearish isn't bearish because it happened last year. End of discussion. No, it's not end of discussion, is it? Semiconductors are still key. Adding it all up, Krinsky says, we would stay light on your feet for the next few weeks and continue to think semis hold the key to the broader market. They are by far the largest industry in the S&P 500 at 15%. So if they were to roll over, that would likely be too much for the market to handle. The Magnificent Seven continues to carve out a top in absolute terms. Jonathan Krinsky says the Magnificent Seven has started to lose multi-month support. In relative terms, the top is more evident and suggests that the Magnificent Seven is undergoing a negative leadership change. On the topic of real estate investment trusts, there's an early stage breakout despite several REITs suffering massive declines last week on the heels of an AI disruption trade. The IYR broadly remains constructive, holding above the key $98 breakout. I like REITs for you and me as a way to own more real estate without having a mortgage or owning the property ourselves. I'm going to tell my kids you can live anywhere in the world you want. You can rent an apartment, you can rent a house, you can rent a mansion. You don't have to own the mortgage as long as you have some REITs in your portfolio. Now, again, that's a very generic, broad statement. I do hope they have some real estate, but I want most of their real estate done through publicly traded companies. Typically, the cash flow is way better than what you can get individually on your own. So there's a global breakout is the final thing Jonathan Krinsky says. After more than a decade of relentless outperformance from the United States, it's quite clear the trend has changed. This is a 2-year high for the all world, excluding the United States relative to the S&P 500. Latin America remains a favorite of Krinsky's. If you follow Krinsky, you're wise. He's been more right than wrong. The Wall Street Journal reported today that activist investor Elliott Management has taken a more than 10% stake in Norwegian Cruise Lines, with plans to turn around the underperforming cruise ship operator. They see potential up 150%. Let's talk about this. Life's been a beach for many travel stocks in the post-pandemic period. Having Elliott Investment Management come up and take a 10% stake in Norwegian Cruise Lines, which is down 15% over the last 5 years, thus not really performing in that great operational environment that has been post-pandemic. Norwegian lags in private island offerings and large ships, while TripAdvisor benefits from investments that will take time. So Elliott Investment Management took a 10% stake. They've highlighted that Norwegian has fallen behind its peers in terms of private island offerings, an area of potential catch-up. Norwegian said in a statement, our board of directors and management team regularly engage with our shareholders to hear their views on our strategy and progress, and we appreciate their perspectives. No one likes for a company to come in, take a big stake, and tell the CEO, COO, CIO what their job is and how they should do it. So that press release is just bull. It's quite a distraction sometimes. Norwegian is amongst the worst performers in the S&P 500 over the past 5 years. Royal Caribbean is up more than 300% over that pay period, but over that same period. Even a market laggard like Carnival has gained 30%. You know, I've told you that one of my recurring nightmares is I'm stuck on a Carnival cruise line with Kathy Lee Gifford. It's an odd recurring nightmare. It tells you how deep and how dark my head is when it comes to the space of cruising. So Elliott is no stranger to the travel space. Its activist push helped propel recent outperformance for Southwest Airlines stock. We've already talked about how that stock has another 3 quarters of growth. It's one of the winners of today's trading in a market that doesn't have a crazy amount of winners or leadership today. So the not so magnificent 7, let's talk about them a little bit more. The S&P 500 has 500 companies. The Magnificent 7 as a group are down 6.4%. The S&P 493 is up 2.68%. So individually, not one Magnificent 7 name, Meta, Google, Nvidia, Amazon, Microsoft, Apple, or Tesla, has seen a positive return this year. The S&P 493 has outperformed every Magnificent 7 stock to start 2026. I would call that the rest of the market trade. Meta's down 1.6%, Google down 3% year to date, Nvidia down 3.2%, Tesla down 4.7%, Apple down 5.6%, Amazon down 12.2%, Microsoft down 15%. You in to do some bottom fishing? Keep in mind, the fish that are at the bottom of a lake are typically pretty hideous looking. The average S&P 500 stock is doing well. Big tech is creating weakness rather than masking it. Capital isn't leaving the market, it's just rotating from tech to other sectors. I do not think this means the era of the mega cap dominance is ending. I think AI has a chance to reignite in the next 2 weeks as Nvidia is on deck to report earnings. Western Digital has said today they're sold out of all their hard drives for 2026 due to AI. Micron is sliding despite AI demand surge as $200 billion expansion. They're sold out of their memory. And they said, we want to make more factories and spend $200 billion to do it. The question is, will that create a glut in the years to come? Due to the AI-driven demand, Micron is only able to supply 50 to 67% of current demand for specialized AI memory. High bandwidth memory is positioning Micron as a major beneficiary of tightening the supply and surging prices. So a $500 billion expansion in Boise, Idaho is bringing up questions. The expansion comes after a worsening global memory shortage, driven by accelerating AI data center build-outs from hyperscalers such as Google, Meta, Amazon. They're crowding out supply for personal computers, smartphones, autos, and industrial uses. Rising DRAM prices are pressuring consumer electronic margins at companies like Apple, Dell, HP, Lenovo, Samsung. Micron is benefiting directly with first quarter 2026 non-GAAP gross margin, GAAP standing for generally accepted accounting principles, of 56.8%. Quarter 2 margin guided to 67 to 69%. Wow. Micron's $200 billion investment plan underscores how structurally tight the memory market has become in the AI era. Near-term supply constraints are fueling extraordinary margin expansion. The margin expansion's good. The bad part is, like I said, I bought a PC late last year before memory prices started jacking up and getting put into PCs, as this is probably my only PC for the next 2 to 3 years, maybe 4 years, until memory prices stabilize. Turning a $2,000 computer into a $2,500 or $3,000 computer is not my idea of a wise spend. Let's talk about some of the other winners and losers today. General Mills, we've talked about GIS, cereal company, largely, lowered its full-year adjusted earnings per share and organic net sales forecast before delivering a presentation this morning to the Consumer Analyst Group of New York. Citigroup was named a top pick at Morgan Stanley, with analysts raising their price target to $152. Citi holds an investor day on May 7th. Morgan Stanley also upgraded Truist Financial to a buy from hold, while raising its price target on the stock to $69 from $56. UBS upgraded Southwest Airlines to a buy from hold. His price target goes to $73 from $51, sees a potential earnings boost from plans for extra legroom, assigned seating, and checked bag fees. Again, that's a no-brainer for the next 9 months, minus something happening in the travel industry that's disruptive, like 9/11. Rothschild upgraded Dollar Tree to buy from hold. they increased its price target to $165 from $75. I'm not, my investment depth doesn't go as far as to get to a Dollar Tree. I guess I'm telling you part of my thesis is sometimes keep what you follow close and don't try to follow too much and don't try to get smart. And when I say that, I see Walmart, I see Target, I see Costco as my retail ideas. Are there more? Absolutely. But do I ever get as far as a Dollar Tree or Dollar General? I do not. This is an interesting one. This morning, AMC is up fractionally on efforts to refinance $2.5 billion in debt. There's so many different reasons why stocks can go higher and or lower. I like earnings, and earnings have been fantastic, and margins are boom. They're improving. Productivity is gaining in the United States, thus making the stock market have a premium valuation for now, looking for that next catalyst higher other than margins and earnings, productivity numbers. Job markets holding up, but weakening. So AMC, back to AMC. Efforts to refinance $2.5 billion in debt. This is interesting. Stock's up. I'm not sure I would buy a stock based on managing your debt. Let's use the example not as AMC, but as your friend. I was going to come up with a female name like Sissy. I'm like, no, there's no sissies on the planet. There's one Sissy Spacek. I don't even know if she's alive or dead. But like your friend Susan. And Susan has credit card debt, and she's refinancing it from 20% to 15% or 0%, but she still got the debt. And in this case, AMC is a human being in my example, because the IRS looks at corporations as humans. They're marketing a $750 million term loan and seeking $1.73 billion in secured debt. The obligations that the chain is reportedly looking to refinance are its $2 billion term loan due in 2029. Priced at 1 month SOFR rates plus 700 basis points and $400 million in senior notes due next year that carry a coupon of 12.75%. That debt is expensive. More expensive than I'm paying. Now again, most of my debt is mortgage debt. I don't have any car debt. Although I do dream of a new car at some point. I know, it's not a good financial issue, but I'm also in my 50s and I probably have one more new car in me. And then that'll run me 20 years, maybe. And then I don't think I'll be driving. I hope I won't be driving because I'm not terribly great at driving now. I've seen a decline in my dexterity and my vision in nighttime driving. Forget about it. I had to drive home on a 3-hour trip in a rainstorm over Christmas. And it was a white knuckler for me. It was a white knuckler for healthy young men too. But I wasn't thrilled with that. I have an event coming up. It's one of my only midweek events. Wednesday, March 11th, 6:30 to 8:30. Beyond the Noise, Navigating Wealth in Uncertain Times. It's at the Lafayette Library. Great location. Lots of parking. I'll be there with Stephanie Richman and Nathan Rogers. As I approach retirement, I love events like these. And usually I do events with CFP Chad Burton, but when I get to do them with Stephanie Richman and Nathan Rogers, it's another perspective. As small as it is, it's interesting to note different CFPs have some different beliefs. And a lot of times you'll hear one CFP, in this case Chad Burton, talk about having an emergency fund to last 3 years in retirement. Stephanie says 2 years. Now, maybe you'll say 2.5 years. I want you to come to this event. It's a free in-person event. You get to better understand today's markets. You get to feel more prepared about your next moves. You don't have to stress about the headlines. It's at the Tatzin Library in Lafayette. If you're heading towards retirement and you want to understand what financial planning conversations you should be having, you can replace your financial stress with a steadier, more informed approach. You want to build a cohesive wealth strategy, how to stay the course, especially when markets feel weird or unsettling. You can sign up for the event at robblackshow.com. That's robblackshow.com. Take a break here. I've got one more segment. Stay tuned.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.
I'm not going to lie to you. I feel every year the market brings us something a little bit different. This year, software is getting whacked. I don't mind that. I don't own a lot of individual software names. I own a lot of the Magnificent Seven, so I feel a little bit upset that since October of 2025, we're going nowhere fast, but I'm okay with that. Why would I do that? Because I like buying on dips, and I've been telling you, I like Spotify. I've never owned Spotify. I like Spotify. And then it dipped, and it dipped, and it dipped, and it dipped, and it created an opportunity to get in. And then you've seen it explode to the upside. I don't dislike, I don't have a lot of emotions when it comes to markets. It's an interesting thing to say out loud. I think that's one of the reasons my spouse loves me and hates me. Because I don't have a lot, I'm not terribly emotional. My highs aren't that high, my lows aren't that low. Let's take a look at the market numbers. And I forgot to hit Bitcoin in the first opening segment, so I will hit that this time. The S&P 500 has broken even after starting the day lower on AI worries. The Dow Jones Industrial Average is sideways as well. It's been in the green, it's been in the red, and right now it's moving sideways. Almost no movement. It is a holiday shortened week. Gold is dropping. But the metal trade remains intact. Very rarely do we ever see commodities and stocks move in the same direction. We have most of that in place right now. Some people have asked me, should I lean on AI for financial advice? I think as much education as you can get is great, but keep in mind, when you're talking about AI, there's a really good comparison. And I don't remember where I heard this story. And how good is that information? It's a really good question. I don't mind using AI to fix up some articles, create some presentations, but it's my data that it's using. I wouldn't be using projections from around the web for helping me. AI platforms have shifted from being a new and unexplored technology to an everyday tool for most Americans. 46% of Americans have used AI, such as ChatGPT, to help with their personal finances. An additional 50% trust AI for financial advice. I think a good financial planner is able to help smooth your information into your financial plan better than AI can go out and get data and say, look at the data. Now, again, I'm not knocking AI because I think the intelligence is needed. But the intel on the individual is also needed. Let's move forward with some more content. I have cash on hand, a couple $1 million, oddly enough, that I'd like to put to work. I'm seeing things like CrowdStrike. Here's some CRWD, weakest performer in tech today. It had its best close on Friday in nearly 2 weeks. AI is coming for a lot of software. That's the expectation. CrowdStrike, Intuit, Salesforce, Adobe, Workday. maybe Palantir, although they're using AI quite well, so maybe I should strike that one from the list. If you want to look at a horror chart, Friday the 13th level, check out the iShares Expanded Tech Software sector, ticker symbol IGV. It's moving towards its February low. As tech is underperforming, Apple is outperforming. It's nuts to say it out loud. I'm looking at names like NVIDIA. Soros Capital decreased its holdings in the stock in the fourth quarter while SoftBank closed its position. Palantir, Soros Capital's closed its position in the stock in the fourth quarter. George Soros' company is not stupid. Why did they close out Palantir and NVIDIA? Adobe is on the verge of its lowest close since March 2019. Salesforce is on the verge of its lowest close since March 2023. Adobe makes creative software that we're finding AI can do a pretty good job of. So I'm going to be paying attention to Palo Alto Networks tonight when they report earnings, as I'm quite interested in Palo Alto Networks or CrowdStrike with some of my cash. I told you I was doing that a couple weeks ago with Spotify, and I think that worked out well. It's rough being patient. I'll be honest with you, that's probably the toughest thing to teach. Susquehanna analyst Christopher Rowland, he maintains a positive rating on NVIDIA and says it's a $250 company for his price target. He is anticipating strong earnings. NVIDIA's Blackwell AI systems show up to 50 times higher throughput per megawatt than Hopper, lowering costs significantly. NVIDIA's Vera Rubin hardware is projected to deliver 10 times higher throughput than Blackwell for AI inference. Inference is the next big phase. If you were to say large language models and inference, they go side by side on some levels, but you don't get to inference till you get the large language models. The analysts at Susquehanna said we expect better results and guidance as the GB300 continues to ramp up through the first half of 2026. AI demand is supported by ever-increasing hyperscale CapEx plans. When you see Micron and Western Digital, as well as other companies in the flash memory, DRAM memory, and hard drive storage lead the markets, telling you it's not just the Magnificent Seven. Please be cognizant of that. Right now, we need the software companies. No, not right now. The market needs the software companies to show that AI is helping versus replacing jobs and replacing product. The replacing jobs is a positive in the long run, but in the short run, we're going, whoa, that happened fast. Tesla's robotaxi added 5 more crashes in Austin in a month, 4 times worse than humans. In the world of autonomous driving, there's a lot going on. Tesla's reported 5 new crashes. The newly filed NHTSA data also reveals that Tesla quietly upgraded one earlier crash to include a hospitalization injury. So if you're a Tesla bull and you love Elon Musk, I get it. The problem that I have with Elon Musk is he's going to be worth $1 trillion probably by the end of this year. His companies haven't earned that much money. The give back on product doesn't equate necessarily in profit. Doesn't mean that all the electric vehicles that Tesla made, the Model S, 3, X, Y, Cybertruck, doesn't mean that those haven't added to society. I think on some levels, EVs really got a big jump start. But Tesla never really earned all that much money. And now we're saying, okay, EVs aren't that important to Tesla. They consider themselves an AI company, XAI. Tesla has submitted 5 new crashes on self-driving that were verified engaged. The new crashes include a collision with a fixed object at 17 miles per hour. While the vehicle was driving straight, a crash with a bus while the Tesla was stationary. A collision with a heavy truck at 4 miles per hour. And 2 separate incidents where the Tesla backed into objects. One into a pole and one into a tree. So Tesla is quietly updating the crashes with NHTSA, and they're redacting a lot of the details. The crash rate keeps getting worse for Tesla's robotaxis. 14 crashes now on the books. Tesla's robotaxi crash rate in Austin continues to deteriorate. Extrapolating from Tesla's fourth quarter 2025 earnings mileage data, which showed roughly 700,000 cumulative paid miles through November, the fleet likely reached around 800,000 miles by mid-January. That works out to one crash every 57,000 miles. The irony here is that Tesla's own numbers condemn it. Tesla's vehicle safety report claims the average American driver experiences a minor collision every 229,000 miles, and they're getting into a crash every 57,000 miles. Tesla's own benchmark is not good. It's not holding up well against it. Waymo has logged more than 127 million fully driverless miles with no safety driver, no monitor, no chase car, and independent research shows Waymo reduces injury-causing crashes by 80% and serious injury crashes by 91%. Waymo has reported 51 incidents in Austin alone in the same NHTSA database, but its fleet has driven orders of magnitudes more miles in the city than Tesla's supervised robotaxis. A lot going on now. Hey, I got to wrap this up. This is getting out a little bit too late in the morning, and I got to work on the afternoon podcast, do some research, do some reading, set myself up to set you up with some great insights. You can always find me online at robblackshow.com. That's robblackshow.com. Big event coming up March 11th in Lafayette. It's one of my two events in Lafayette. There's one in the first half of the year, this one, and there's one in the second half of the year, and that's going to be it. So this is with CFPStephanie Richman and Nathan Rogers, Wednesday, March 11th, 6:30 to 8:30. I'll get there around 5. I'll stay there till about 9:15. You can sign up for the event at robblackshow.com. That's robblackshow.com.
Visit The Rob Black Show online at robblackshow.com. Listen to archived podcasts, market updates, and information from EP Wealth's certified financial planners online at robblackshow.com.